Hi, everyone. I am delighted to welcome with me here today Didier Choukroun, who I have now known for a couple of years, more than 2 years now. Welcome, Didier.
Thank you very much, Swati. It's a pleasure to be here with you.
Didier has a very long history, and we will introduce that in a little bit more detail. And Didier leads Sphere Healthcare Investments, which is a healthcare real estate focused fund. I would let you go ahead and talk a little bit about Sphere Investments first, and then we'll get into your background as well.
Sure. So Sphere Investments is a firm I founded in 2010 that is dedicated to healthcare investment management and primarily real estate investment. We started this company with a goal in mind, which was to improve public health. And that's really the name Sphere as an acronym for strategic public health, equities, and real estate. I would say that since 2010, we have had a lot of success expanding in 15 states in the US. So the headquarters is based in Miami, but we have assets in 15 states. We mostly own medical office buildings, surgery centers, but also hospital, post-acute care hospital. And in 2024, we decided to expand in Europe, and we have now offices in France, Italy, Spain, and soon the UK. So very excited about our new expansion. We believe that what we have done here is quite unique, and we think that we can also add value to the European market. So that's really the goal in Europe. And I would say that the building blocks of Sphere and the reason why we were so successful, and we can talk about the measurement of success, right? But the building blocks really were unique. One is our investment in data analytics. So we are data driven, which is really something I'm very proud of, that effort that we have made in investing in data. The second aspect is the multidisciplinary team. Every single individual that have joined me since 2010 come from primarily the healthcare industry. So we have a lot of physicians, we have a lot of public health experts, but also the data science world. We're statisticians, data scientists, mathematicians that help us to make sense of the data and try to forge a strategy that really help us to mitigate the risk and take advantage of opportunities. And so that's the second building block. The third is the verticality. We are vertically integrated, which means that we don't surrender any aspect of the investment management value chain, from creating the strategy, from identifying opportunities, creating the relationship with the operators, but also managing those assets, from asset management to property management up to dispositions. We have already disposed of 12 assets since 2010. We are long-term investors, but sometimes it makes sense to turn around some of the assets, and we are doing all of this in-house. We have never used a broker or advisors on the buy side, no on the sell side. So
Yeah.
that's
Thank you. Fantastic. And you manage about 1.3 billion in assets across, if I recall correctly, 39 assets across 15 states. Is that right?
that's correct. But in those 39 assets, we also have assets in France. So 15
In
states plus,
France,
yes,
Spain, Italy, UK, world
yes,
dominance.
yes.
Great. Congratulations. And in these 12 assets, what I want to highlight to our listeners is your track record of success. In these 12 assets that you've disposed since 2010, you've managed to deliver a very high IRR, which frankly most VCs would envy. Do you want to talk a little bit about that?
For sure. And you have to be careful. You have to be careful about those success metrics, right? It's sometimes very easy to do those type of return. What is important is to look at the range of returns on all of the assets and the span, right? Because you need to be able to deliver those type of results in any cycle. And real estate is very sensitive to those cycles, even if I would say healthcare is a little bit different from the rest of the asset type in commercial real estate. But truly, the first asset we disposed of was in 2013, right? So 2 years after we acquired, 2.5 years after we acquired that assets. And the last portfolio we sold, the portfolio of four assets, was in 2020, and the range of returns was on the lower side, and I will explain. The 2020 was a 15% IRR to the transactions, and on the higher range was a 42%. The
God.
average, the average was 23.5% on average, but I wanted to mention the range, and the reason why we deliver 15% IRR in the asset we sold, in the portfolio we sold in 2024 in December, is because one of our investors, the foreign investors, wanted out for many reasons. It was the end of the life cycle of their particular investment, and that was the worst time to sell healthcare assets in the US. And it was really a portfolio that was performing fully leased, but we did it because we wanted to execute on the need of that particular investor who controlled the LP capital in that particular portfolio. But yes, we did very well, and we have had the chance to have great LPs, great investors, very institutional in nature. And we are very, again, and we'll talk about my personal track record. I have done IRs that were much more than those that I just expressed, but they were due 99% to chance, 99% to the market who carried us, and we were lucky. In healthcare since 2010, we really are curating every investment, and we are very, very proud of what we have done. So I attribute the result a little bit more to our work rather than just chances.
Yeah, no, absolutely. I mean, consistently over since 2010 to now, delivering an average IRR of 24.5% is very meaningful, very incredible. Congratulations. And on top of that, you've delivered a high cash yield every year, right? So your annual cash yield is above of 10%
Yes,
on
and that's
average.
very important because delivering those type of IRRs when you flip assets,
Yeah.
right? And I have to say that the average holding period was in excess of 4 years. So these are not IRRs that you get in 15 months, right? Because you flip assets again. It's relatively easy to get those IRRs if you flip assets within 15 or 18 months. So now we really have a holding period which is mature for those type of assets. But most importantly, as you mentioned, the nature of our assets is, I would say, core, because we only buy assets that are fully leased. Generally, we are bringing value before we close. So we have acquired several assets that were 60% leased or 50% leased, but we have brought the complement, the tenancy at closing. So for our investors, when they enter into a deal, they know that the deal is totally at closing, totally stabilized. So we don't take the risk. We add value before we get into those deals. And then the assets has all of the characteristic of a core asset with long-term leases, but nonetheless, because of the nature of
Specialty. Yeah.
of the specialty and the effort that we have done in curating and creating those opportunities, we are able to deliver those type of yield, which are normally yield associated with core plus or value
Exactly.
add deals, right? So stable, but cash flowing at a very interesting rate, and still able to deliver IRs that are also interesting. And that's really the value of our enterprise, is because of the data, because of the fact that we have public health leaders and doctors at the helm of our company, we are able to establish direct and authentic relationship with the operators. And the characteristic of healthcare real estate is that still until now, more than 85 or 87% of all the properties are owned by the operators, right? It's not a very populated market for institutional investors like residential or office or retail is or industrial, right? Here, it's a love relationship that needs to be created with the operators. Generally, most of the transactions are sell and lease back. So you need to really being able to demonstrate value beyond just what you're able to buy, right? And that's why other group in our space are doing well, or also have a even greater presence in terms of size, but very few, and I would say none of the top 10 in terms of size are able to generate this type of
Yeah.
yield and this type of return because they buy assets on the market. Generally, when you participate to a call for offer, you do, right? You're going to try
Yeah.
to beat the competitions. So they buy at very, very tight cap rate. The reason we are able to be immune from this is one, because we never buy assets on the market. We never participate to those calls. And we try through our data, and it would take more than one podcast to explain what it is, but we add a ton of value to the operators beyond the acquisitions. We have become a de facto advisor to many of the most prestigious and leading systems and fiducian practices in the US because we bring a lot of intelligence that help them in resolving many of their challenges beyond just financial challenges.
So, Didier, we should talk about the process in more detail. But before we do that,
Yeah.
please tell us how you got into this. I'm curious, even I'm
Wow.
curious to learn more about your background over the years.
Well,
Let's start from France,
as you
from your
can
undergrad.
tell, and as your audience will obviously identify, I have a strong French accent, despite the fact that I've been here for 30 years, but was born in France, born and raised and educated until at least undergrad in France. And I, out of college, started to work for a very large French construction and real estate development company, one of the top 10 company in France on the Frank Stock Exchange. So very, very large company. So I worked in their real estate development branch. I was in charge of the international development. So outside of France, I have the chance to speak several languages. So they thought that even with a lack of experience, they thought that I was the right candidate. And so I spent a lot of time doing the analysis of market outside of France. That was a long time ago. And after a few investments that we've made, buying land and buying building to demolish and refurbish, they decided to send me in Spain to lead the opening of the office of Bouygues, which is the name of this large French company in Spain. So I spent 5 years at that company, and then for personal reason, decided to move to the US. I met an incredible young lady from the US and uh, fell in love, and she did not give me a lot of choices. So I have to move to the US, and that's how I came to the US.
She's
And
still with you, Esther, uh,
still
as
married.
part of
Yeah,
Sphere.
I'm happily married now after 33 years of marriage, 3 kids. And Miami has been home for the past 30 years. But when I arrived here, my English was very basic, number one. Thank God I spoke Spanish, was able to integrate the Miami community. Miami was a small village 33 years ago. So it was difficult for me to really find the right opportunity from a job point of view. And, I became an entrepreneur by default. There was no other opportunity. So I worked for a year and a half for Colliers International. I was, in fact, hired by Colliers to develop their entire network in Latin America using my Portuguese and my Spanish to do that. And I was able to, during 2 years, to travel Latin America. We did very well to recruit all of the network for Colliers, which, by the way, if you look at the Colliers affiliate in Latin America, they are still the company I pitched to and integrated into the Colliers office. But very quickly, by analyzing the market, that was the 90s, right? Mid 90s in Latin America, I saw that there was a need for a more investment management type of company rather than commercial brokerage. And with an angel investor, I created my first company in 1996, which was dedicated to investment management. And we were representing mostly US pension fund, Canadian pension fund investing in Latin America in the mid 90s to the almost 2000. Everybody thought that Latin America's economy were once for all out of the trouble they have had in the 80s. And we did very well. And I was extremely lucky to sell the entire company to a subsidiary of the French bank BNP Paribas. So we sold to BNP Paribas Real Estate. I sold the entire company in January of 2001, just before the entire economy of Latin America were flipped with the devaluation of the pesos in Argentina at the end of 2001. So I was lucky because it was very hard work for 6 years, 7 years to build that particular company. We had 5 offices in the major market in Latin America. And I was, again, lucky. Timing was here very, very important. And I was lucky to sell the company to the French bank BNP. And I learned a lot. I learned a lot on how to work with institutional investors, what were the requirements, the processes in place that were necessary not only to qualify opportunities, but making sure that those investors could invest and get out as promised or as established in those investment memorandums. So that was an incredible opportunity to learn. And financially for me, thanks to the exit, was also very gratifying, right? As
Yeah.
a first experience as an entrepreneur.
So you speak French, Spanish, Portuguese, English, and
Yes, yes, and some Hebrew.
some Hebrew. Fantastic. That is so impressive. And then you've actually been an entrepreneur, built a company ground up from with an angel investor. So you're
Yes.
very familiar with the Latin American market. Sold it also, so you know the ins and outs. Many congratulations. I didn't even know this, Didier, and we've
Yeah, yeah.
we've
So
spent so
that
much time with each other. So congrats. And then what happened? What did you do
so
with the
then
proceeds of sale?
So 2001, company BNP asked me to remain as president of the entity for 2 years. That was part of the contract. I sold 100% of the shares of that company. So when I was free to depart from the company, I decided to now really look at the US market, right? I turned my back to the US since I arrived from a professional point of view. And so I decided to create a company by the name of Flagler, and I'll explain why Flagler, and invest, in fact, the proceed of the sale of my first company in real estate as an investor, right? So from 2004, which was the creation of Flagler, up to 2010, Sphere, right? And we'll talk about the crisis in 2008. I was investing in buying distressed assets, extremely distressed assets, mostly distressed office building and data centers, right? After the dot-com, you had a lot of data centers that were empty. People did not have the foresight to see what was coming. And I was, again, I have to absolutely say that with limited knowledge of the market, because until we created Sphere and what we did on the data analytic, one of the characteristics of real estate is that people operate blindly, right? With
Yes.
a total asymmetry of information and very, very limited, grossly limited level of information, right? So without a lot of information, we were able to buy assets at a very distressed price. If I tell you that I have never paid more than $35 per square foot for every single asset I acquired from 2004 to 2007, which was the last asset acquired before the crisis. That gives you an idea of how shitty the assets were, right? The risk we took, right? Where we were, I had full personal guarantee on all the loans, and we were losing money from the day we acquired to the day we lost, we sold. But the idea was flipping those assets, right? Is we had on average about 17 months of holding period. And again, we were extremely lucky because in the world of office, that was a time that the condo office became a frenzy, and mostly in South Florida. So I remember, and you talk about IRRs, if I tell you that I did an IRR of 1,000%, you would say 1,000%. I bought an office building at a few blocks from where I am now, right? On Flagler Street. That was the name of the company. We bought a building that was 50% occupy. It is known as the second jury building in Miami. Very old building on a ground lease. Obviously, 50% losing money. Systems were totally outdated. And we bought it at $35 a foot. It's a 180,000 square feet building. So, right, big building, no parking. We sold it for $158 a foot in 18 months to New Yorkers that thought that they were going to convert into office condo and sell the condo at $300 a foot. They went bankrupt a year and a half after they bought. But imagine the flip, right? We were one of the conditions was to acquire the ground lease. We were able to acquire the ground lease, but we paid $5.3 million for the leasehold interest. I had to pay $1.8 million for the ground lease. We sold the building for $27 million. So,
Many congratulations, Didier.
but
I hope New Yorkers aren't listening to this.
no. But what I'm saying is that was pure luck. Because if you look at when I bought the building, what was the logic? My rationale was downtown was improving and it took much more time. We were going to turn it around. We didn't have parking. We signed a convenient agreement with a parking from the city. I thought that within 3 years, I could make a turnaround, and I was expecting to sell the building for $12 million. That was a vision, right? Not that, right? So that's what I was saying is that a lot of what we have done, we were very lucky because 99% of what we have obtained is due to luck, to event that I did not anticipate. So I don't take the credit. And the same way, we did several of those, mostly with the data centers that we bought empty. We bought 6 data centers from Realtel Communication, who invested millions and sold it for pennies, right? And we were lucky to hold, and the market turned around and people bought it from us at a much higher value. But in the crisis, and let's go to Sphere now, we were caught in 2008 with 2 assets, same nature of assets. And the fact is, I had to surrender one asset. That's the only assets where I lost 100% of the capital. Obviously, it was mine. I didn't have any investors. So the impact was really my impact, right? And we have another asset that we own, another office building in Atlanta. It took 10 years to restructure because it was a complex. If I had been caught in the crisis with more than 2 assets, it would have been a catastrophe. What was an incredible success financially could have been a total catastrophe. And that's really,
No, Didier, here is the thing that fortune does tend to favor the bold, and fundamentally, you had a vision that Miami was going through this change. You invested yourself in that vision, you capitalized on it. You expected to sell a $5 million building for 12 million. It ended up selling for 37 or 27?
26 and change.
27, right? So, yes, it did you did have a little bit, maybe a windfall or fortune was in your favor, but at that time had it not been in your favor, you would still have doubled your capital, right? So that would have been incredible. And I think these are the success story, these are the stories that people live for, right?
Yes, true. But I would tell you that the model we have on the Sphere, the way we work today, help us to really
Mitigate
anticipate
risk.
much better, right?
Yes.
And mitigate a lot of the risk and really have a sound strategy, which is also for a different nature of capital. I have to admit that I was much younger. Our kids were younger. We have a very stable lifestyle, which has never changed over the years. So I was able to take the risk. But if you ask me, putting my family in potential danger with absolute personal guarantee on all of the loan. Looking back, it paid off. It's not responsible. And the reason why I think it's an irresponsible way of investing and doing business is because of, again, the lack of understanding, the amount of blindness that existed. I say existed because, as you know, with AI, a lot of things change dramatically, and hopefully we're going to see those areas of shadow to come to light, right? But in real estate, at all level, and I talk, and I'm not going to drop any name, but I'm in contact and working with a top firm that everybody admire, I can tell you that they are still working as if they were in the Stone Age. People are investing with very highly limited understanding of the risk, right? Because healthcare is very difficult. Healthcare has a lot of opportunity. The fundamentals are great, but understanding really the operation of healthcare is very, very different than any other asset type in real
Yeah.
estate.
So, but I know that sphere is very different from others. I've been there. You walked me through your data strategy. It is, I will tell you, I was so impressed because coming from Silicon Valley, everything is very data driven here. And I was so impressed by what you've accomplished. And clearly, that strategy is very different from what you were doing, I would say, in the early 2000s, right?
Yes.
So tell me about your current strategy and how you came up or how you decided to pursue this instead of kind of blindly taking risks, as you mentioned. Because now it's a very data driven, risk mitigated strategy, right?
Yes. Yes. So the investment in data, right, came originally from a normal reaction when you invest in real estate. When you invest in real estate, you need to be able to underwrite the risk of your tenant, right? So you need to fully understand the operation of the tenant. So it started by what if we want to invest in healthcare real estate, what is our capacity today to really understand the part of the systems or any tenant and understand the operation. And going way beyond when you start understanding healthcare and the complexity of the healthcare system in the US in terms of reimbursement and in terms of competitions and regulations, you realize that you need to go very, very, very deep in the entire knowledge of the sector in order to be able to evaluate the capacity of that particular tenant to sustain all of the disruptions in the market and be able to pay its rent, right? That was number one. Number two, we also, as I mentioned, if most of the assets are owned by those group, and if you want to differentiate yourself from anyone coming with a large pocket and say you want that cap rate and we can offer and we can beat Sphere on the pricing, and at the end when you sell, you generally want to sell if you don't have any other argument to the highest bidder. We decided to also invest in understanding the space and understanding the challenges of our tenant, right? Even if we felt comfortable with our ability to pay rent, we wanted to build a value propositions where we were offering more than just the real estate or more than just a financial accommodations when there was a need of a monetization of assets, but really becoming a partner in their growth. To do that, we needed to understand their space better than them. And when that evolved, we realized that whatever we could find was not sufficient. So we decided to look at healthcare data analytic company to buy. And we acquired in a company by the name of Prime Healthcare Analytics that was at that time owned by Konica Minolta. We became at the beginning, we were a user of the service, right? And then we acquired the entire company. That gave us a base, right, with the entire infrastructure of that particular software and hardware that they that was gave us a not only a base, but we acquire the employees. Part of the employees at that time were the original founder of the software, and we evolved in creating an in-house data analytic platform, which today is really spectacular, is helping us to do much more than real estate investment, and we can talk about that. And it's very unique because it cannot be replaced with AI. If you look at what AI is doing today, is helping a lot of companies to not aggregate information, but get to a result using
Completely
mass,
available.
well, mass of knowledge that nobody knows where it's coming from, but the result seems to be satisfactory and allow you to gain time and potentially expenses, right? We go to every single data that we have, or either public information that we go and get to the source of the data, private information. This is agreement that we have with healthcare providers, or some are proprietary and others are private that we buy, right? Very few assets, but we buy some data. But most of what we do, or I would say everything that we do, start with the core data that we refine ourselves. And based on the data, we have created tools that help us to make decisions, help us to identify needs. So we're using AI today, but we're using AI to help us going faster in all of the process of study, but the source of the knowledge is ours, right? And that is not available. You can chat GPT, anything that we do, you're never going to get to the answer that we have, right?
Yeah.
And you're never going to get to the tool that we have created. Again, we say we have 4 functions for all of the data. One is to inform the strategy. So all of those data is regulations that we follow, reimbursement issues, macro element. The second function is identifying opportunities, either by understanding the void in the market for healthcare ecosystems, or by being able to analyze in existing assets. The third function is eliminating bias in the decision-making process, right? This is the underwriting, making sure that we go through a very exhaustive and very curated underwriting. And the fourth function is helping us to expand. And that's really on creating new ideas on where to invest. We have started to invest now in operation. We can discuss about our private equity investment strategy, but we have also now creating a new company in healthcare credit, right? Which is totally different from the real estate, which is a private credit platform. But again, using the core foundations, which is the data.
No, thank you. I've seen the power of your platform, and so I can attest to that, and it's super impressive. Thank you so much for that background. I want to talk about Propel and our
Yes,
partnership, right?
yes,
So
yes.
tell me what I know what prompted me to get into this, but tell me what you think is the benefit of a platform like Propel. Why did you choose to partner with Propel?
Yeah. So, as you know, because this has been the subject of our conversation for more than a year and a half, um, we have always complained that the type of assets and opportunities that we are generating are generally limited to institutional investors, right? Because of the size of the investment. But private investors in the US, outside of the ability that you may have, we may have to buy a share of a publicly traded REIT, which is not really exactly the same, none of the private investors have the ability to invest in those vehicles.
Correct.
Why? Because from a sponsor point of view, if you really create value and you have quality asset and you want to really achieve a certain level of scale, which is important, you can attract a lot of the institutional, and it's much easier to negotiate with a large institutional platform, form a joint venture where they will bring 95% of the investment in the vehicle. These are vehicles of two, three, four, $500 million, rather than trying to recreate what you have done for another sector. There are also regulations that are not easy because you don't want to be subject to some of the SEC regulation. Yeah. For vehicles that are generally adapted to the retail. So we always looked at how could we diversify our source of capital, because for a sponsor like us that has the ambition to grow, that believe that is doing a mission that is important for the community around us. Outside of us going to those investment managers, we don't have many other opportunities, right? It's difficult for us to go directly to the pension fund. I think that they will come back after 2008. They would rather invest with those large investment management firms. So it's difficult for us to diversify. And we always look at being the same way I mentioned that we are vertically integrated on everything we do, and we don't want to be the hostage of a third party in the mechanism. We'd love to be able to go at the root of and at the source of the capital, which is either the pension fund capital or the retail. And we thought that you could be an incredible partner to do this because you have demonstrated over now close to 8 years your ability to identify incredible opportunity. You have a large, very large group of trusted investors that have been with you investing in all of the VC type of deal that you have
Yeah.
offered and hedge funds. And we also know by looking at the platform similar to yours that have looked at or chosen real estate as a sector, we know that they have not been successful, right?
Yeah.
And the reason why they have not been successful is because of the lack of quality of the product.
Yeah.
A platform like yours is being used by investors that needs to find capital within 2 months because they have a closing and they have no other investors probably because the property is not that great. They have a gun on their head, on their head. And what you have seen by looking, and we have done the work together to look at the platform that are dedicated to real estate, we know, right? Beyond the smoke, we know that the result is really bad and we would not invest in those platforms, right? I'm not saying that every platform is at the same level and some deal may be good, but consistently, these are not deals that will be attractive to institutional investors. So what we are trying to do, and it's still a challenge because the challenge is really the communication and making sure that we have the time to scale. What we are trying to do is use your reputation, the fact that you have successfully demonstrated that you can do what you have done in those asset classes, and we are willing now to partner to bring institutional level opportunities to the retail investors. Obviously, it has to be accredited investors, right? At the minimum. And I think that no, we just started this adventure, but I think it's going to be exciting and I'm convinced it's going to be very successful.
Yes, so am I. And thank you, Didier, for your trust in us. And likewise, I want our audience to know that just like you take great pride in the deals that you've done, we take great pride in our curation. And um, this is the first time I've really felt this desire to partner with someone like yourselves because you have such an incredible track record, and more than that, it's the process and it's your people which are I have met over time, and whether it's it's the physicians or your operations team, it's really incredible. It's a very high class operation is what I would say, and so that's why we are so proud that we have this partnership, and I am looking forward to its great success. So any last words for our audience?
Oh, I would love to meet the audience, right? We talk
Yes,
to them. I think that your audience will be obviously comprised of very sophisticated investors that know a lot about what you're doing and what you're investing on until now, but surely also real estate. And we love to engage with them in conversations, the opportunity to demonstrate, right, what we have been doing and hopefully offer alternative that they don't have today that could be interesting for them because I think that it's important to diversify and real estate is definitely an asset type that anyone want to have in their bag
yes,
of investment.
yes. Thank you, Didier. Thank you for being with us today.
Thank you very much, Swati. A pleasure.